Hello, hello, hello. Welcome everybody to another Monday night. We've been here for, I feel like every week when Monday comes again, I'm like, wow, when was the last time we did one of these calls? Every Monday seems like it's so far away. But we've come a long way, and we're going to give everybody kind of a little bit more, a little time to jump in here before we get started with our guest. So while we do that, I'll just kind of introduce myself again, reintroduce myself, and share a little bit of who I am and why I'm doing what I'm doing. All right, so I'm your host here, Alex Lovely. You can find me on Instagram at Alex Lovely. Check out my podcast that changed my life. And I started this call really because I feel like there's something missing in our society. And I know a lot of people on YouTube and a lot of educators share this same thought, which is, the journey, the investment journey, the financial freedom journey that our society has created for us really doesn't work. Putting your money into 401k, into IRAs, they just, they don't really work. And I've seen it. I've seen it firsthand. I have friends that are in the same space. And people will continue to struggle with money for a really long time if you don't break the chain. And so I was born in Taiwan. My mom and my dad, they were pretty well off in the beginning of when I was a little kid. I grew up with kind of like maids and stuff like that that took care of me. So I lived a good youthful life. And my grandfather left my dad a huge company, a company that built bridges for the government. So it was a really big company. I remember at one point when I was young, he took the entire company. My dad had like 250 employees. Took the entire company, rented out a giant jet or plane, and flew to the Maldives. And that's where we like vacationed, and that's the amount of wealth that my dad had. And I remember that was maybe when I was like 6 or 7. And within 2 years, all of that was gone. It's because the chasing of money, no matter what size a company, right? Because it was actually a large company given to my it was a large company given to my dad and his brothers. And I don't know, it's kind of like there's a Chinese saying that's like one generation makes it, the next spends it, and then the next one loses it or something like that. All right. And I think that company has just been passed down through generations in my dad's family. And towards the end of my dad's life, he was struggling so much. Like he had three other kids when my mom and my dad divorced. My mom actually had all of her money and she was co-signed onto the house and everything. And when my dad lost the business and lost all the stuff, the house was frozen and then my mom's bank account was frozen. So she ended up having all this money also doing, I think she was selling like insurance or something. And she ended up losing all of that. So with whatever she had left, she divorced my dad because my dad also, had got another woman pregnant. So, besides the point, my sister and I were brought to the States. And growing up, it's not like I was deprived of anything. I think I had a pretty good childhood, but it was always like there was always struggles about money. And I want to be that person in my family that breaks that chain. I want, my goals are still to is around money. Like this year, what's my monetary goal? How much do I want to invest? I'm still in that process of breaking the chain. Okay, in my lineage. There's always one that will do it. And it comes from a mindset of breaking free from the money game. Okay, cutting the cord that has time and money connected. That's got to happen. So when we invest passively, when we learn to invest in real estate and multifamily and things like that, even though sometimes it looks like, oh, it's really just 4, 5, 6% cash on the year. But as your time becomes more valuable to you, those investments become more valuable to you. And that's why we have to start now. We got to start that pushing the ball up the hill. Because at some point, there will be a tipping point and you will break it. You will break that connection of time and money. And without doing that, no matter what size company you have, okay, no matter how much money you're making, you will still be chained to it. So when I talk about like wanting to create financial freedom for people, it's not just financial freedom like money freedom. It's really time freedom. And if I can, if there could be one thing taken away or remembered on this call, because I believe everybody knows deep inside, right, that human beings, like, we want to be free. We want to be free. All of us innately know that when we make investments, sometimes we aren't making it for freedom of time. We just completely forget and we just trade more time for more money. And so breaking free from time, I think, is or to remember that time is the most valuable commodity. And we all know this, but I want to make sure that you guys remember it. And that on this call, somehow you can connect the dots between real estate, multifamily investing to freeing yourself of time, or disconnecting that time and money conversation. So this is a call dedicated to the remembering of how precious time is for all of us and that we need to stop wasting it. That means every opportunity you have to save time, you should figure out how to do it. And being on this call, you are spending time, your precious commodity, to be here. So I really appreciate all of you guys that are here right now. And I hope that in this hour and a half that you commit yourself to learning or hearing something that's going to save you time, that your 1 hour invested is going to save you hundreds of hours of time, thousands of hours of time. And so the invitation is that you be here like you're looking for that. You're looking to trade 1.5 hours right now for 1,000 hours. Okay. It's not even 10x. We're like going 1,000x. And I've made a lot of mistakes in my life. I've made a lot of money, lost a lot of money, and then made a lot of money again. Okay, so I know that journey of the up and downs. I know what it's like to worry about money. Like, am I going to be able to pay my bills, right? Or how much time do I have left with the amount of money I have in my bank account? And then just and if you have a W-2 job, having the false sense of security that this guaranteed paycheck is going to keep coming. Oh, but it will not. There will be a point where it will stop coming. By then, would you have created and invested your money in the right places so that it doesn't matter if it stops coming? And so all of us we're all on that journey to break free. Okay. So today I've brought a special guest. I think we've given enough time for people to hop on. I hope that you guys all jump on time on the next call. But I want to bring a special guest here because he is also generously sharing with us his time, because he's got a wealth of knowledge. He's in probably the most confusing and misunderstood sector of real estate investing. Okay, probably most people don't invest in real estate because they don't understand this aspect. And this is the debt side, right? We really just don't even know the impact of debt in general, right? Like what does it mean that, my interest rates are up 2 or 3 points? What does all that mean? How does it affect you? How does it affect my investments? If you've invested in the deal in the last year or year and a half, okay, and you are looking at 2x returns in 5 years, or you're looking at 8% cash on cash, all of that, okay, because of what happened in this last year, most of it is wiped out, if not like at least delayed a year or two in the returns that you think you're getting on a real estate deal. Now, how does that happen? Okay. For example, I will use one of the deals that we have. Amazing deal, meets the 1% rule, which is the rents are $775. We bought it for $76,000 a unit. Okay. Those are when you can buy a deal that meets the 1% rule, usually you can buy it eyes closed. Okay. Because that's just how solid a deal is. You probably can't really find deals like that anymore. Now we've increased the rents from $775 to an average of $900. Okay. That should increase cash flow, one, and also that should increase the evaluation of the property. Right. If you take 40 units, okay, this is quick math for everybody. Value equals NOI divided by cap rate. Okay. So if you take 40 units and you increase it by $150 a unit, that's $6,000 a month times 12 months. That's 72 extra $1,000 we should be making on the property a year. And if this and this deal, let's just say it's a six cap, okay? I don't know, maybe it's like a 7 now, but let's just say it's a 6 cap divided by 0.06. We should have made an evaluation of $1.2 million. Okay? But because interest rates going up, because expenses going up, all sorts of things are happening that are really hurting the evaluation of real estate deals. So our NOI, we increased it by $150 a unit. Insurance, okay, insurance went up $200 a unit. All of those profits that you should have gained right there is erased just from insurance. And then taxes also went up, right? Taxes also went up drastically. Now we're chasing. We got to figure out how we can lower expenses or increase NOI, but we increase rents. Like we had the conservative calculations on it. And technically in 5 years, 7 years, I'm sure we're still going to be fine. But for everyone that's kind of looking for short term, this is what happens in real estate cycles. And so I'm going to bring Derek from Arbor to the spotlight here with me. And Derek has...
Try and move this back a little bit here.
There you are. So I'm spotlighting the two of us so that we can have this conversation. And then for everybody else, if you have questions, please feel free to either type it in the chat. I'll have my chat box open over here, or you can raise your hand. All right. Raising your hand. I'm going to say this first before we start this conversation. When you raise your hand and you talk, people get to know you. And part of being on this call, if you want to create maximum value for yourself, have your video on, ask questions, and be seen. Okay. That's one of the first things about coming onto one of these Zoom calls is you want people to know you. Okay. The questions you're going to ask, you want people to see you and hear you. So later on, when we do a breakout room, people will know who you are already. Okay. So Derek, why don't you introduce yourself? What do you do over at Arbor?
Yeah, well,
And
thanks
then
for
we'll just
having
get
me.
started.
And I just wanted to second that on the questions. The questions are really good because they help me sometimes back up a little bit. I get going too fast. And so, yeah, please feel free to slow me down. So what I do, I'm a nationwide lender for Arbor. I do fixed rate commercial real estate loans, Freddie, Fannie, HUD. I do floating rate construction bridge. I do build to rent loans. I do single family portfolio loans. So pretty much anything in the multifamily space, is what I do. And I've been lending for 15 years, doing commercial lending.
Time out for a second here. So this is when I said most people are not utilizing and investing in multifamily or doing real estate deals because they don't understand debt is all the different types of debt, because they're all different strategies that you can leverage and use to take down deals. And the more you understand about them, so if you don't know what a HUD loan is, you should ask in the chat. Okay? If you don't know what, anything that Derek is saying means, you got to ask. Okay? Don't There is no stupid questions here. So we'll put that out there. All right. So Derek, go ahead. Sure, continue to share with us a little bit, just what's going on in
Yeah,
the market.
sure. So,
Yeah.
there's a lot of dislocation in the market. I think that's the best way you can say it is, since the last time we talked, we've had three of the four biggest bank failures of all time, right? And that is putting a capital crunch on a lot of the other banks. You see a lot of heavy deposit requirements, a lot of high spreads, because that's essentially what got, the banks in trouble, where we're having, and it's a similar issue to what's going on in real estate. You've got, as interest rates go up, the value of assets go down. Essentially cap rates follow interest rates. A higher cap rate means you have a lower property value with the same NOI. Same thing is true for banks. If you make a bunch of loans during 2021 when interest rates are 3% and now a market rate is 6%, the value of their loan book at 3% is significantly diminished, something like 40 cents on the dollar. And that's the story of First Republic. Silicon Valley Bank was a little bit different. That was treasuries. So they had a windfall of profits during 2021 and they turned around and invested that in treasuries, but had the same net impact. They bought, let's say, an average treasury coupon of 1.5%. There was a while where you could get a 4.5% treasury. So why would anybody want to buy their 1.5% yielding treasuries? So that
Wait,
devalued their
let's
balance sheet.
slow down a little bit. I think people, some of these terms people may not understand. So first,
Yeah.
like the First Republic went under because they had too many loans that were 3%, and
Yeah.
then now all of a sudden they can't sell it, right? Because they can't sell the loan, it's worth a lot less. When interest rates are higher, for those of you guys that are new, when interest rates are higher, it means the cap rate, which means cap rates is the expected returns on a deal when based off of cash purchase, based off of your NOI, your net operating income. When the cap rates are higher, you take the NOI and you divide it by a higher number, you have a less evaluation. Okay, so it's the same exact thing that First Republic went through, which is they got these loans, they wrote all these loans at 3%, and then these banks, when they give you a loan, they go turn around and sell it and make a small profit on it. But interest rates shot up so fast, they couldn't sell it because it was worth less. That's why First Republic went under.
Yeah, and it's called a mark to market, where you have to go through, and if you sell any of your loans, you have to reclassify the value of all of your loans currently on your balance sheet at their new market rates.
Mm.
And when they've done that, their balance sheet was upside down. But they're not the only bank that was making low rate loans in 2021. I mean, I hope everybody on this call got a 30-year mortgage at 3% or 3.5 or something like that during 2021. And so any banks that were making those loans, they all have, who do banks sell loans to? The banks do a lot of different things with their loans. You could do a Freddie or Fannie residential loan and sell it through the Freddie or Fannie platform. And I do Freddie and Fannie commercial loans. We sell, that's called the DUS system if we're talking Fannie Mae. And in that particular system, they're not necessarily mortgage-backed securities where you're bundling them all together. You're selling individual DUS loans to individual buyers. There are middlemen that are ultimately buying these DUS bonds on behalf of sovereign wealth funds, of pension plans, of really anybody who needs a fixed return but can't take any risk. That investing in multifamily is taking some risk and increasing your return. Some of these funds maybe aren't allowed to take any risk at all. So they have to buy what is perceived to be really low risk uh, government bonds or mortgage-backed securities.
Yeah.
So yeah, so that's, and then some banks will sell to other banks. Different banks have different. Wow, that's a great rate.
Yeah, that's
That's a
crazy.
nice rate. 2.1. I wish I had that.
Yeah.
Um, Actually, I do have a First Republic loan on my house, so I was part of the problem for that. But anyway, so banks are all struggling with that same issue where they're in a liquidity crunch. And then the second part of that, so their loans are devalued. Now you can go online and get a 3 or 4% yield in a savings account, or you can, as a consumer, you can go buy a treasury and get 3.5%. So most consumers that are doing that are moving their money away from really low rate deposit accounts, earning 0.01 at Chase, and they're moving to an online savings account that's paying 3% because it's better than nothing. But that is taking all that low cost liquidity away from banks' balance sheets. So banks are really feeling a cash crunch, and it's making them not lend as much. And then you've also got the issue of smaller banks that which normally fund a lot of our commercial real estate loans losing deposits to the too big to fail banks, to Chase and Wells and Bank of America, because they've been deemed systemically critical, and they essentially have unlimited FDIC on their customers' deposits. And so you have small banks that make 60 or 70% of the commercial real estate loans, especially in more tertiary markets,
Hmm.
are in a real credit crunch. And so that's impacting the market because they were a really good source of debt for the last 2 or 3 years. The agencies are still good. The agencies have their strengths and their weaknesses. I've been a bank lender before, but I do agency loans now, so I can speak to that. The strength of an agency loan is you should get a low spread. You'll get a consistent funding. It's non-recourse, but you've got to underwrite the current cash flows. So when you go in day one on a property, that's what we're using to qualify you for the loan. What is a spread? A spread is the margin over the treasury. And a typical spread these days on an agency loan is between 175 and 275, I'd say. The bigger the loan, um, generally the lower that spread is, which is why we all have power in numbers. That's why we pool our money together and buy stuff instead of going out on our own and trying to make it work with 5 units, because you just don't have the same buying power, not only to negotiate the property but also to get the best debt.
Hmm.
it, the loans that are north of, let's say, 6 million, north of 10 million, they are just going to price tighter. And it feels much more, does it fit in the box on lower loan amounts than it does on bigger loan amounts. So the bigger the loan gets, the more exotic structure you can get on it. The longer the IO term, the lower the spread. Um, so so that, there's power in numbers. So it pays to remember that.
Hmm.
So that market is doing good. The Freddie and Fannie are funded by the government, by the Federal Housing Authority. They fund the insurance pool that covers Freddie Fannie loans. So investors really like that their principal is guaranteed by the government. The securitized loans that are non-Freddie or Fannie are struggling, sort of like the bank loans are. That's more funded by private investors, and they're starting to get worried about principal. So spreads and that's like a CMBS market, if you've ever heard that term before, commercial mortgage-backed securities. Those spreads are significantly wider than the agency spreads would be.
Because
And
it's
then
more,
life
it's
insurance,
riskier. It's also riskier, so they want the spread.
the investor, that end user of that debt, of that bond, is not having their principal balance guaranteed, right? Like they
Mm.
could lose their principal if the loan goes bad. If the lender who put the portfolio of loans together goes belly up and the property isn't performing, they could lose their capital investment. With the Freddie or Fannie loan, the investors have that, at least the principal, not the return, but they have the principal guaranteed to a certain extent by the government. That's why the spreads are tighter. That's why that particular part of the market is holding up better than other parts.
Yeah. What about like insurance, like life insurance and these types of
Yeah.
insurance company loans?
Life codes can be good, you know, that they can be selective, but life deals can be really good. It's essentially like, you know, pick your insurance company. They're accepting premiums for like a life insurance policy, let's say, and then they're guaranteeing a fixed payout, and then they've got to pay a death benefit. So they're trying to make as much money with that capital in the meantime. So some of them make loans, you know,
Hmm.
Symetra or whoever they are make loans. I would say, you know, they're more they can be more finicky. You know, they can be really good at times and then really bad at other times. It's much more go shop it, you know, find out who's doing stuff at a particular time. While the agencies are pretty consistent, but yeah, life deals can be very good, you know, in the right market and for the right deal, and
Oh,
bigger loans again. Yeah,
yeah.
they focus
So
on
I
bigger
mean,
debt.
look, this seems like things that we should understand. Now, why is it happening though? Why has the government, because this is really the government initiating it, and they should be like, if you and I know how this works, they should know how this is working, and they're intentionally taking these local banks out of business. And these they know where they're at. They know where Silicon Valley Bank is at. They know where
Yeah.
First Republic is at. And by doing what they did, it's like they knew that they're doing. So what? Why do you have a
Yeah, of
theory
course.
on
Yeah, I
why
can
this is
answer that.
happening?
Yeah, I
Okay,
can answer that question. I mean, and
cool.
I don't think that they necessarily want to put them out of business, but they're trying to combat inflation. If you can pull up a graph of the M1, I don't know, I should have sent this over in advance, but look up M1 money supply and the St.
Hey
Louis
Nick,
Federal
can you
Reserve.
can you do that, Nick?
Yeah, if
Yeah,
you Google it, it'll be the first thing that comes up. M1 money supply.
and then
That
share
is a
your screen when you're
measurement.
ready. Uh-huh.
Yeah, and that is a measurement of all the liquidity in consumer accounts. When we pull this up, you'll see the graph, but essentially it's pretty flat from the 1960s till 2020, where it just goes vertical. And this is causing inflation. You know, that's the chart of money in consumer accounts. That's the reason why rents have been able to go up so much.
Uh-huh.
That's the reason why food is so much. That's why vacations are going up so much, because of all the programs the government came out to stimulate the economy during COVID. And if you zoom in on that, you can see the date, and it's March of 2020. You know, that's right when it happened. And like this graph takes us. It's a little small on here, but it goes. If you zoom in on it, it'll go all the way back to 1960. So you can see how flat our money supply has been. Economists have said that this is not necessarily connected to inflation, but when you have this kind of increase, it is just most certainly the cause of inflation. And we really haven't, seen inflation in 30 years. And so the Fed is raising rates to try and combat this inflation that was caused from all the stimulus that happened during COVID. So they don't want to cause a recession, but I think they essentially have to slow down inflation, and it's creating a lot of dislocation in every asset class. You know, whether it's the treasuries that Silicon Valley bought, whether it's the mortgages that First Republic made, whether it was the real estate that somebody bought at a three cap. The cap rates have to follow the interest rates, and with SOFR, the SOFR is over 5%. That's the short-term borrowing index. Yeah, LIBOR. Yeah, it's correct. LIBOR was rigged. I mean, I guess the guys in Europe were doing a little bit to influence it. I mean, I don't know that it was by a significant amount. It might have been by basis points, but still, yeah, it was replaced by SOFR, and so that's what that is. That's a short-term borrowing rate. The Fed benchmark rate is north of 5% too. That's the rate that the banks can go and borrow from the Fed at. You know, the Fed window is over 5%. The prime rate is over 8%. You know, these are really high compared to where we've been over the last
What's what's
15
the what's
years.
the what's the difference in those? And then I see two hands up too. So what's the what's the Fed rate? What's the prime rate for everybody else that's, new?
So the Fed fund rate or the Fed benchmark, the window rate is what banks go and borrow from the Fed at overnight, or go borrow to make loans with, because that's how money creation happens is, banks essentially borrowing from the Fed and putting money out against a small component of their deposits. Um, the prime rate the Fed also adjusts, and then treasuries are the debt instruments that the government uses to cover our deficit. So we run $1 trillion deficit every year. The government funds our debt and our budget deficit by issuing new treasury bills. And so, we're paying, and treasuries are quite a bit lower than the shorter term indexes, which is really why it's so much better today. This has all been kind of theory. This is where this becomes actionable. The treasuries, which are what uh, agency loans, fixed rate loans are indexed over, are pretty low. The 10-year treasury, I think it's roughly 365 today,
Yeah,
3.65%.
yeah.
The prime rate is 8%. SOFR is over 5%. So if you've got floating rate debt, that a typical floating rate loan would be 400 or 4%. Whenever somebody says 400 basis points, that means 4%. 100 basis points is 1%. So 400 over SOFR means your rate is over 9% today. That's on a floating rate. That would be for a construction loan or a bridge loan or something that isn't stabilized. A stabilized deal, you could get let's say it's a larger deal in a decent market with a reasonable down payment. I mean, you could get a 180 spread over a 350 treasury. I mean, so we're talking low fives.
Wow.
You can make that work. You can make a fixed rate deal work. It's going to take a little more equity to do that. But the floating stuff at 9% is just so hard to pencil and so risky because you have a shorter maturity. On a floating rate bridge loan, you might have 2 or 3 years to before that loan comes due.
Hmm.
And with a fixed rate loan, you might have 7 or 10. So it gives us a chance to extend our time horizon and let our rents catch up to the cap rates essentially.
So, okay. So somebody, there's a lot of people stuck in this floating rate right now, right? There's a lot of people stuck in it. And they took the adjustable loan kind of during that last period of the threes, right? And all of a sudden this shot straight
Yeah,
up, which
when
nobody could have
SOFR
predicted, which is crazy. But what do they have to do now?
SOFR was 0.05 during
Yeah, it's crazy.
2021, and it's 5.05 today. SOFR is up 5%. You could have had a SOFR plus 400 loan that was 4.05. That is now 9.05%. Your debt payment, even if you're interest only, has more than doubled on that deal. You essentially just have to get out. But the trick is you probably levered up because those bridge loans generally give you more leverage. That's why people do them is because you're using the future cash flows to underwrite so you can finance more. If you're buying a $10 million property, you can maybe finance 75% on a bridge. So you get a loan of 7.5 million instead of a loan of 5.5 million. So
Hmm.
you didn't have to raise as much equity and dilute your returns. You like to have as much debt as you can because it makes your returns better, but not if it pushes you into a product that's really risky and increases your cost of capital and doesn't allow you the duration to take the risk away from your investment.
So at the time, right? I mean, there's really a lot of people, and we already saw somebody fall. Actually, that group in Houston, right? That guy in Houston that fell really early on, like really quick, and you guys took that back over, right? You guys had a private group that bought those properties. Is that how it went down?
Yeah, it's something like that. It wasn't my loan, so
Well,
I don't want to. Luckily, I'm glad, happy to report that wasn't mine. But I think yeah, I think it was something like that. Like there was somebody that had equity came in, and picked it up, and we'll make it work. But yeah, that's the risk of the floating rate stuff because you're not getting in. to a property that's cash flowing on day one, probably. You know, you're getting into it, you're building in an interest reserve like a construction loan, you're trying to
Mhm.
finance based on the future cash flows, and you're doing that so you can lever it up more, which just all of these things collectively are like the recipe for stress
Mhm.
right
Now,
right now.
a lot of people took that. So do you see that banks, including you guys, are you guys looking to take back those properties if or are you guys trying to work with the operators? Like what's the thinking
Definitely want
behind
to
the
work
lender
with
side?
people. Yeah,
Okay, cool.
and I made a lot of those bridge loans too. You know, we got rate caps on most of them. You know, you could go in and purchase an aftermarket rate cap, but those are, a lot of them are will burn off at some point. You didn't normally do them for longer than a couple of years. No, we definitely don't want the properties. Yeah, and that's I think whenever you're talking to lenders, especially in the world of bridge loans and private lenders, you don't want to work with a lender that wants your property ever. You know,
Yeah.
and we're not that type of lender. Like the reason why Arbor makes bridge loans and construction loans is so we can do the exit financing. You know, we can do the agency loan at the end of it. That's really our business. And so we're trying to do everything we can. If there's a scenario where we have to take one back, it is not because they want to. Like we consider that a failed loan for us.
Yeah.
We want it to pay us off.
How should somebody approach you guys, right? So let's say they're in trouble, right? I know many operators right now that are going negative. There are negative. We have one deal actually that is also kind of in the negatives right now in terms of the rents not being able to cover the loan. What is an approach that we should be taking to work with the lender?
Well, as long as it's a lender that doesn't want your property, I think it's good to be really transparent and show them what you're doing. I think the worst thing they can do is get surprised and have a lot of vacancy. I think the best thing you could do is be really transparent and obviously try to get at least, if it's not the closer you can get to it penciling, even at a 1 to 1, the better. The more vacancy, the higher delinquency, the more scared they're going to be. So
Mhm.
so I think communicating and then just doing everything you can to get at least up for them, and just being honest. If you're working with a lender that you think might have, and there are a lot of private lenders where they go, well, if I'll buy it for 70 cents on the dollar, essentially. And
Mhm.
I would say those are the ones that aren't doing cash flow analysis. If you ever have a lender that isn't considering your cash flows, that's probably a sign that it's a "we'll take the property back if it's not
That
working" type of lender.
guys, that right there is your money moment that will save you thousands of hours and time and all the stuff is what how you're borrowing the money, right? Like if they're not considering your cash flow and they're just, they're ready to take your property back. Those are the type of lenders talking about. So they're like more private. They're not going to be
Yep.
somebody that's like you guys.
Yeah, it's probably not gonna be somebody that does any long-term mortgages. It's probably just gonna be somebody that makes private loans and private loans only. And
Mhm.
so, yeah, I think be really careful with
Yeah.
that. If I had a deal that was stressed with one of those, I would try to get it away from that lender as quickly as I could to somebody else that's a lender that wants to be paid off, that doesn't want bad loans.
Mhm.
Um,
So what should the operators be doing? Should they be because I see a lot of people just jumping in and doing cash in refinances, like all sorts of stuff, just to
yeah,
refinance it into something right now. Is that the smart play? Or if you had the money, should you wait it out?
no, I think it is the smart play right now is raising the extra equity and getting it paid off. Do a short-term fix because I do think rates are going to come down. I mean, I don't have a crystal ball here, but I don't know how they can't. It's been the most aggressive tightening cycle we've had in decades, and
Mhm.
there's stress. Cracks are appearing everywhere. I don't know how rates can stay high. I think the Fed will have to. I mean, if inflation is coming down too, which is the whole reason why the Fed is raising rates. So I do think at some point soon we will start to see rates coming down. So I would refinance to like a 5-year term if you can. Maybe pay a little extra for a flexible prepayment penalty and plan on refinancing it to something better when rates come down, but getting away from it. I don't think it's a good strategy to hang in there with it right now, especially with lenders that are maybe feeling stressed because there's a whole chain of capital too. If you're working with a smaller lender, there's a decent chance that they have a warehouse line or something with Goldman Sachs or with Morgan Stanley or with one of the mega banks. So essentially, a mega bank gives a warehouse line to a smaller lender. The smaller lender takes that warehouse line and relends the money out. Those bigger banks will call and are calling those smaller lenders warehouse lines due, saying you owe us everything. And so those smaller lenders are going to put a lot of pressure on their borrowers to pay them back or takes drastic steps to take the property so they can sell it and get money to pay back their warehouse lines.
Hmm.
So I think I don't think it makes sense to stay in that no those turbulent waters. I think in times of turbulence, you just steady the ship. You don't chase the 15% return, the huge cash out deal that that pays you a ton. I think you just sort of mitigate your risk as much as you can. You take a more conservative approach. Say it's all right if I get 5%, for the next year or two. I'll fix it in year three. And so that's my that's my everybody has a different risk tolerance, and I'm somewhere in the middle, but that's where I would come out today if somebody asked me to make a decision for them like that.
Gotcha. Okay. So if somebody is in the middle of CapEx work, right? Like, and they're drawing from their CapEx budget and, their reserves, what should they be focused on immediately? Like in the middle, like they're in the middle of the CapEx work, like already full blown going. And now
Hmm.
they're, seeing 9-10% in their interest rates when there was once 5, 6. Right. So what then?
Well, it depends who your lender is, and it depends on what the cash flows are right now. Like, is the property totally vacant or is it a phased CapEx? How are
Yeah.
we? And would
Hmm.
it pencil if you refinanced it today to get a clean break, or I guess how much new equity would you need? Sort of
Okay. Yeah.
all those factors come into play, I think. But if I had a lender I was comfortable with that was going to continue to let me draw and understood my business plan, and I was running my projections to say, in 12 months, I think I can be out of this thing. I'm leasing it up currently and it's working. I might hang in there in that situation. If I was with a lender I was nervous about, and it was cash flowing good enough to get me out today, I would probably just say okay, and get out of it.
Yeah. Gotcha. Okay, so here we got some questions here. Let's go through these first. Um, if she has multiple commercial loans, is it a good time now to consolidate?
So multiple commercial loans to consolidate them into one.
Yeah, I
So
guess.
different property loans,
Hmm.
consolidating them. I don't know that it necessarily matters that the loans are different or not. I mean, I suppose there are critical dollar amounts where you get better access to better pricing and better programs. So if you were consolidating two mortgages to get above, say, $1 million threshold, that would open up a lot of financing options to you, and I think would make sense. Um, in general, if I don't need to consolidate loans, I generally don't, because you lose a little bit of flexibility. A lot of lenders, if you sell one of the properties, your whole loan goes away. You've got to pay off your full loan, so though you're essentially tying those two properties together. So you sort of in general prefer to keep them separate, but if they were all long-term holds for me and I was moving the debt together to get it into special programs like, maybe a life insurance company or HUD loans, generally you don't do a HUD loan below 5 million. And so I was
Mhm.
pulling them together so I could do a HUD loan. Something like that could make sense.
Yeah. Lyra, do you have other questions? I think you asked something about, is it a good time to refinance too right now?
Yeah. Yeah, that was me asking that question. I just wanted to see, what are options that I have, right?
Yeah.
That make sense, right?
Yeah,
Um,
well, what are you refinancing from? What's your rate and how long is your fixed term? And do you think there's room for cash out? Is there?
Yeah, so that's kind of what I'm thinking of is I think that if I consolidate, again, I'm guessing, right? If I consolidate, then I can do some cash out. One there because there are several of them. One of the and most of them, the loan, they're 5-5, every 5 years it changes, right? So
Mm-hmm.
one of them it's due this year or in a couple of
Mm-hmm.
months.
Okay.
So yeah, the interest rate then was 5.25. So now it's going to go up, right?
Yeah.
And then I have several that are the same. One of them already went up to 7%, right?
Yeah.
Yeah. So
Get
I'm
rid of
just
that
trying to
one.
see a better way to see, is it better to consolidate them, right? And then look into getting some cash out as well.
Sure.
So
Yeah,
wondering,
if one is coming due this year and one is already north of 7, I would
yeah,
definitely refinance those.
okay.
I mean, no reason to pay north of 7. Are they in the same MSA?
What is MSA in
Medium.
terms of bank?
Sorry.
I
Yeah,
know it's a
median
master
surrounding
service
area,
agreement in my world.
Are they in the same city, or same area, same
Yes,
submarkets?
same area, and then it's from the same bank as well.
Gotcha. So yeah,
And
so if they're already consolidated, you could do that. You
yeah,
could put
and
them
this is
together.
the type of bank that you spoke about earlier. They want to take your property because
Right,
it is a recourse loan. That's
right.
also why I want to get out of it. I want to go into a non-recourse.
Yeah. Yeah, well, I mean, for low rates and non-recourse debt and some interest only and cash out, that sort of has all the agency, selling features written all over it.
So is this something, Lyra, what kind of properties are those? They're multifamily, how many units type of
They
things?
are several sixplexes, right? So 3 sixplexes and a duplex. So I have several.
Duplexes contiguous with one of the sixes, uh, on the same or budding lot lines.
Yeah, so it's one duplex, right? And then 3 sixplexes in the same city,
Hmm. Is the
same county.
duplex right next door to one of the sixes?
It's like a couple blocks from it.
A couple blocks. Okay. So that's a really that yeah, it's interesting. So for Fannie, this is just an interesting case study. Fannie Mae would do the three sixes together as one, and then Freddie would do them all together. Freddie just started letting you do 4 units and under if it's bundled together with six pluses. So Freddie small balance would let you do that today, and the rates would be either in the high fives or low sixes depending on what fixed term you did. And I would probably do like a 5-year fixed term just to give you some flexibility,
Mhm.
to get out of them. And then and then you could cash out however much the cash flow supported.
All right.
They
How can
don't
I contact
agencies.
you? I need to have a phone call with you.
Sure, sure.
I'll put you guys in a chat, and then Derek, do you care if like a whole bunch of people just started calling you and texting you and reaching out to you
No,
for stuff?
no, that's my no.
Okay, because
Nope.
you know, people that have been on
Impromptu calls are great.
my CPA came onto this call and he's still trying to answer calls, and this was months ago, you know, from people here, which you know, he's like, he's so backed up, he's afraid to jump onto this call again. You know, he's like, I hired more people, and he was like, I'm ready. He came on a second time, and the same exact thing happened. And you know, now he's like, you know, he's really backed up, and we're trying to figure out how he can still support everybody here, you know, but because he got so many calls. So if you're okay with it, then you know, feel free to leave your number and your contact info in the chat. Um, you know, you're probably gonna get a lot of
Yeah,
questions and a lot of calls and stuff, and Lyra's gonna reach out to you and maybe do a refinance with that with you. I think
I'm here
that's
for you, and I promise if it doesn't make sense to refinance, I will tell you that too.
Well, yes, that's what I need.
It's a long-term game. Like you need to have people you trust that are honest, and so that's I'll always be that. It just does sound like a good situation
yeah.
for you to
Perfect.
And
refinance. No, no
you got most of you guys know too. Like I don't just bring anybody onto this call. The first time I ever spoke with Derek, he stood there and talked to me for like 2 hours. Okay, we were at what was it? What was that conference? The big MF.
NMHC,
Oh yeah, here in Vegas.
MF.
We just like stood there at Starbucks and talked for like 2 hours. And I'm just like trying to understand how the debt and the banking system works, and he was just trying to explain it to me, and we just kept going. And I feel like I was more confused after, so he came onto one of my calls, and you know, I still don't fully grasp it, you know, but you know, at least the whole line of how the debt happens, right? Like you said, there was a warehouse, you know, there's a beginning where they get the debt from, and it goes all the way down the chain.
Uh,
um
That's what's confusing is it's all different. Every single product works a little bit differently,
yeah,
and so that's what makes it so hard is, you don't have warehouse lines for agency loans. You have, we're basically table funding it with our balance sheet, and then an investor like a sovereign wealth fund comes in and buys the debt instrument from us, and then we service, we service the
service the
loan for
debt.
them
Yeah,
for for some really incremental fee. But yeah, that's the business model for a
yeah,
seller servicer, like Arbor. And
awesome.
then bridge loans and construction loans, we use, or smaller lenders especially use warehouse lines. So yeah, it's and then some private lenders are just funded by a family office, and that are really like real estate investors themselves, and those are sometimes the guys that want your property. So, it's like it's all different. And I think it will, over the course of your investing careers, it will make you and save you a lot of money and time if you sit and understand the funding source of the capital for your deal and make sure it all lines
Mm,
up and makes sense. And find people that you trust along the way to tell you the honest to goodness truth
here, I'll
about
write
it.
that down. Yeah. Okay, cool. So Lyra, I'll connect you guys, and then if you want, Derek, just put your contact info in the chat, and then we'll bring Donna up. She's got a question next.
Hello.
Thanks, Alex. Thanks, Derek.
So
Anytime.
is there ever a situation where a property's underwater, but you can still refinance it? Because most of the times it seems like that's when you need it most, it's not available for you.
Yeah, that's the tough one, isn't it? What kind of property is it? Is it an apartment we're talking about?
You can pick one, doesn't matter. Sure, apartment.
Yeah, it's all, I would want to understand why it's underwater. Is it underwater because the debt is really high right now and they can't support it? Is it underwater because, there are a lot of repairs that you made this year? There are certain expenses that we can add back and make it look better, on paper than, sorry,
Yeah.
go ahead.
No, I'm sorry. This happened years ago with a single family house, but
Hmm.
to us,
And so then that's loan to value we're talking about, right? It's worth less than what you owed on it. That's the
yeah,
underwater, is not cash flow. That's value.
right.
I don't, other than, I mean, if you have other assets, I could see lenders maybe taking cash out of a different asset to pay down the debt on this one. But really, there aren't any lenders that will lend you more than your property's worth, unless you can secure it with something else. So if you have a really big balance sheet personally, if you have a, $10 million stock portfolio, somebody might secure it with that, but if it's, and that's what makes it so hard to do this business by yourself with your own, with just your own balance sheet, because there's really nothing else, to team up and take on and get you out of tough spots like that. If you personally don't have anything else that they could secure it with, and the loan on the property is higher than the value, yeah, you're pretty screwed on that one. I mean, I wish
Yeah.
I had a different answer.
No, it's all right. I mean, it's over now. We ended up doing a strategic default. Yeah. It was a long
And
drive.
I've had family members that did that too during the recession. So
Yeah.
it happened to everybody. It's nothing anybody should be ashamed about. And just the Great Recession there. That was, that what we're experiencing now is not related to credit losses in any way. But banks and lenders are not taking losses on their loans. Default rates are really low. This is right now what we're dealing with. It all has to do with duration risk or interest rates, right? It's just the devaluing of properties because rates have gone up. So it's a different time, and so things are a little bit different. But I think generally, if you focus on cash flow, you don't have to worry about the value. I don't think you buy property. This is my own personal investment philosophy. I don't think you buy properties for appreciation. Appreciation will come as you improve the cash flows, but buy the properties for the cash flows, and you don't really have to worry about that. You'll have the money to make the payments. Lenders generally don't give you too hard of a time if you're making the payments and the property's making money. So just moving away from I'm going to buy a single family because it'll appreciate over time to I'm going to invest in a multifamily because it makes cash flow every month. I think that's the winning. I think that's the winning formula over the long run.
Okay.
Yeah, that's where we're headed.
Couple questions, and actually this is going to bring me to what I really want to know, and Josiah is kind of leading to it right now. So for someone that's transitioning right now, or just anybody that's looking to get into multifamily, is it a time to buy now, or should they wait?
I think that there are always opportunities, and I think you have to be particularly careful right now, but there are deals that make sense. You just have to be really cognizant of when you're looking over pro formas that it all makes sense to you, and maybe even go check out what their budgeted rents are and go see if this is if that rent is really what things are going for in that area before you invest. I actually invest too in syndications personally. And that's how I approach it is I look at what kind of debt they're getting, if they're getting floating rate debt or if it's too highly levered. That makes me, that's a sign I'm uncomfortable with. If I pull up some comparable properties and the rents are significantly lower than what they're budgeting, that makes me nervous. If the sponsor isn't putting their own equity in the deal, that makes me nervous. So no, I think it's always a good time to invest in the right deals if you're really particular. I just think right now you have to be extra particular because there hasn't been credit losses. That's maybe the shoe to drop that could dislocate things further is if you do start having significant loan losses. That's sort of in the back of my head when I'm investing in deals, but I'm still investing. I mean, I did, this year within the last, 3 or 4 months, I personally invested. Sorry, I think there we go. I think I'm back. So yeah, it's just, it was the right deal. It was a fixed rate loan. There was more equity coming into it. So it wasn't a heavily levered loan. It was something like 45% equity. So it dilutes my return as an investor, but I'm thinking long term. I like the depreciation. I like the long term value appreciation. I believe that in multifamily over the long run, there still is a housing shortage, no matter what happens in the short term. There's really good tailwinds, but I just think for during 2020 and 2021, in 2019, and you could have just closed your eyes and said yes to any offering memorandum that came across your desk and done fine. And I think today you can't approach it that way. You have to be really selective about who you invest with. And the I guess maybe the three things that I would look at what are the going in cash flows today? Does it make sense? I would look at what type of debt are they putting on it? Is it fixed rate? Is it floating rate? Who's it with? How long is the fixed term for? And then I would look at, is the sponsor putting in their own equity into it? Like those three pillars. I think if you can check those boxes and you can keep a reasonable expectation for return, the days of doubling your money up in 2 or 3 years are just not here right now. But if you can, but if you can change your outcome to saying, hey, if I can get an adjusted 7 or 8% with the tax benefits, hey, like that's a hell of a lot better than I can do anywhere else, unless I'm just getting lucky in the stock market or getting lucky at the casino. So
Yeah.
that's where I'm at.
And this is actually, my theory, and tell me what you think about it. So look, people got into debt, like, got into loans that are a 3% low interest rate, and they lost evaluation in the deal, like, because interest rates went up. So if we got a deal that made sense today, and when interest rates come down, like, that's going to increase the evaluation of the property, right? So actually,
Yeah.
it's probably a better time to buy. If we can make sense of a deal at high interest rates now and moving forward when the interest rates come back down, I think, I don't think people should be trying to time the bottom, right? And I also don't think people are going to bleed out as much as people think is going to happen, right? There's a lot of like fear kind of going that's like, hey, don't buy any deals for the rest of this year or next year, like get ready to buy in 2025. And I just think, how many people miss opportunities because they wait, right? And there's always a reason to wait. The interest rates are so low, and it's overpriced, so we should wait. And now things are coming down and interest rates are high. People are like, oh,
Yep.
should we wait? Let's wait till it comes back. Like, where are people supposed to get in? And and I think, like you said, it's the cash flow. It's those
Cash
things.
flow.
Hmm.
If the cash flow's there, it doesn't hurt to wait.
Yeah. It
If I'm
doesn't hurt to
making
buy now,
money,
you mean?
yeah, or no, I mean, it doesn't hurt to wait, for the market to improve, right? Like
Hmm.
it does for values to improve. Yeah,
Yeah.
that's what I mean. Like, because you're always like you're thinking I'm going to time the low point for the value, and then I'm going to sell it like at the high, and that's what like that's great if that happens. But if you buy for cash flow, if it makes sense today, it's gonna you can afford to wait into the future. And if you don't, and if you get a 5 to 7 year fixed,
Hmm.
if you get a bridge loan that's due in 2 years, yeah, you could there could be credit losses, and values could go down significantly next year. If all that's happening, but you have a fixed rate loan on your deal and your deal's cash flowing, who
Doesn't
cares?
matter. Yeah.
Yeah, who cares? I mean, it just doesn't matter. It will always come back over the long run because we're printing more money. Inflation is embedded into the system, Banks lend banks on average have like 20% of their loans. That's money creation. That's all the new money being flooded into the economy. Like their assets are always going to go up in value over the long run. You're going to have periods of contraction and pain, and you're setting yourself up to have to live on that roller coaster if you go into floating rate debt or short term maturities. Because maybe you're chasing like a real deep value add deal to do that. And I think that this is maybe not the unless I was like really deep pocketed and could afford to lose, and I'm not, and I won't. But I think it's a good time to just buy for cash flow and let this pain sort of smooth its way out.
Mm-hmm.
And if you don't find the right deals, then, you don't find the right deals, and be patient.
Yeah.
It'll come up if you're looking hard and working with the right people. And again, like, build your networks, like, pool your funds together. Like, don't go at it on your own. You're making it harder than it needs to be, by
Mm-hmm.
doing that.
Yeah. Okay. So we have another question here by John. And hey, thank you, Jennifer. Jennifer is really answering a lot of the questions in the in the chat for us too.
I just want to chime in and say, good to see you, Derek. So Derek and I are connected. I
Oh,
would say that we're
hi.
professional friends. He's highly vouched for by people within my firm. I'm with Toro Capital. And so I just want to, back up everything Derek says. He's super strong. I really vouch for him. I like to be engaged, so therefore I'm, answering in the chat since
I
Derek's
love it.
busy. But just wanted to throw that out there and say, hey, Derek, good to see your face.
Thanks
Yeah.
for coming. No, and love to have you. Abundance mindset.
Yeah,
There.
exactly.
How do we grow for everybody? How do we all do well together? I firmly believe that, when we pool our resources, when we talk together, when we're honest, like, we'll find opportunities, and things will work out better than being a lone wolf. I can just say from experience, the sponsors and the biggest loans that trade are not. It is not a one-off individual doing it. It is groups and teams, and those are the most efficiently run properties and operators I have and I work with. So,
Mm-hmm.
yep. And Jennifer and I would work together, on a lot of deals. We do work
Oh,
together. So,
awesome.
yeah. So,
That's right.
Well, welcome, Jennifer. So there's another question here. John Hoffman. He says, if you use a DSCR strategy and you will need 20% down and do not have it, and your other option is put, what is that, private money lender, but the lender will not let the second lender. Okay, so yeah, most of these, they're not going to allow a second position, especially if you have a small balance loan, right? And the strategy to make the
no, not really. No, no. I don't really know any lenders that want a second. And
yeah.
you can get pref equity, like a preferred equity, which is sort of like a piece of debt, but it's not. And so we do some financing with that, but it's quite expensive, and they usually have removal rights. Like, they can essentially take you out of the deal if you don't perform.
It's called the mez
So
debt, right?
Well, that's pref equity.
Okay.
Mezz debt is more like a subordinated second, and yeah, and same sort of a similar story, but you don't usually have the removal rights with a mezz piece.
Mm-hmm.
That's sort of unique to the pref. Um, but again, I think it's safer just to have limited partners or be general partners. You're dealing with a lot of Wall Street when you start playing with that. A lot of those guys are Wall Street type. And
Yeah,
so,
I
and not that
refuse
there's
to
anything
do it.
wrong with that. I mean, Arbor's on Wall Street, so I'm not, I don't want it to come off wrong, but there are, the safest way to do it is just to have LPs and GPs that are sort of all in this thing together, and you might have to come up with more equity, but just meet more people, work harder to do it. I know equity's tough right now, but don't take shortcuts.
Mm-hmm.
The shortcuts to capital, I think they can ultimately cost you in the end. The safest thing you can do is to just find more LPs to come in on a deal and take it at 60% loan to value if that's what it works at. There's a
Yeah.
reason why an agency loan is gonna come in at 60 if it's coming in at 60. Because in theory we could go up to 80% or 85% with HUD. It's
Mm-hmm.
it's just that the property is not producing enough cash flow to support it. So don't shortcut that. Like, go in and raise enough equity to take the risk off the table. And when times are really good and properties are appreciating, I have a different stance on this because I've done bridge and mezz and pref loans. I've done all this. And when things are good, I'm more comfortable taking these types of risks. Is you've got the tailwind of appreciating property values. You can always just sell it and recoup your investment if something goes wrong. Not knowing the future, not knowing what the next year or two looks like, I think you really have to get back to the basics of fundamentals and cash flow. You know, that's where you take the risk and the guessing out of this is you, and then your value add is just icing on the cake. And like Alex said earlier, when interest rates come down too, that's going to be a very profitable refinance for you.
Mm-hmm. Yeah, I think that's that's why I think for me personally, I've always just looked at the deals, and if it made sense, it didn't matter where the market was, in terms of debt and all that. As long as I can underwrite it
Yep.
and it makes sense, it cash flows day one. I like the Freddie and Fannie, the criteria that you're looking at lending based on today's cash flow, not a future.
Right.
So, okay, last question that I have for you, and then you guys have Derek's number, and you guys can feel free to reach out to him. So, what's the difference between now and 07, 08? Like, what are some of the main differences? And is this another one of those times? I say that there's probably like 4 times in our lifetimes that we have these real estate cycles where it's in this contraction. And if you can make deals happen, it can drastically shift your financial position greatly. And all of the Grant Cardones, all these big guys that made it, they made it because they bought during the 07, 08, times. And all of a sudden their portfolio exploded because they made millions refinancing. I
Yep.
know, like I was just at a mastermind. Robert Martinez bought all these property, or he started buying in 07, 08, 09. And he has like 10x his investors' money in some of the deals, like buying deals in Houston at like $20,000 a door.
Isn't it crazy? Yeah, Texas specifically has had what an incredible tailwind down there. That it's maybe getting crushed right now with property taxes and insurance,
Mhm.
but yeah, that was incredible growth. You know, the difference between 2008 and now, the 2008 financial crisis was essentially built on really shoddily underwritten loans. You know, there was all of that whole CMBS market, what mortgage-backed securities were not being properly underwritten to cash flow. You know, it was sort of in the vein of what we were just talking about, like people buying for appreciation because real estate always goes up in value, right? In the long term, sure, but not in the short term. In the short term, you have ups and downs. The cash flow is what is consistent. So that's one of the big things. And today it's just interest rates. The second thing is employment. You know, the unemployment rate today is all-time lows. The unemployment rate in 2008 spiked really high.
Mhm.
I think some of that has to do with the M1 money supply, you know, that we built up with in COVID. Like that's a lot of that is funding a lot of jobs, and there's just still a lot of liquidity in the system right now that wasn't there in 2008. Um, what's sort of negatively different this time is interest rates were low for 15 years. Interest rates were low from 2009 till now. Really, the bedrock of our whole economy right now is built on low interest rates. Everything. I mean, the government is issuing treasury bills to cover our debt. They were paying 2% on their treasuries. They're paying 4% now. That's coming from our government. Like we're built, our debt load, our ability to service our debt as a nation is built on low interest rates. Commercial real estate is built on low interest rates. Banks' balance sheets are built on low interest rates. And so that's a little different. We've never had a period of time where things have been near zero rates for 15 years and then went vertical like they did. I think how fast inflation comes in and how fast the Fed can ease rates will dictate the severity of a downturn. You know, if they can do that, if they can bring in rates in a way where we don't cause a lot of credit losses, I think everything sort of shakes itself out and is okay. If they have to keep rates up longer and a lot of this floating rate debt or debt that's maturing can't get paid off, that's when you start to see credit losses and maybe some deeper issues. But I still think like 2008 was sort of an anomaly of its own, just because it was all built on fraud, basically. You know, a mortgage officer, you know, and this is sort of embarrassing, but I worked at, you know, Washington Mutual to Chase, like during that conversion. And so like a lot of those Washington Mutual loans we were doing were somebody come in the morning, you know, you'd say, well, how much money do you make? I make $1 million a year. Okay. You know, you put it in the system and have loan docs formed later that day, like just no real appraisal, no real income verification. That's sort of a house of cards, you know, where you're just really not doing anything, any sound underwriting. And today you do, you know, today you have sound underwriting. You know, you have all the Freddie Fannie programs are cash flow based. Like most lenders are doing the same thing where they're looking at it, somebody's personal cash flow or looking at the property cash flow. Yeah, the Big Short. Yep. Yeah. So I think that it's fundamentally different from that sense. And then all the liquidity in the market is real. You know, there's a lot of money in consumers' accounts is still being used to stimulate our economy. So we still have that really resilient consumer right now, which is 60% of the U.S. economy is consumer spending, right? So that's and you know our rents are consumer spending. You know that still is real. So it's a really hard time to figure out. You know, just being entirely honest, it's tough to know what's going to happen and when it's going to happen. I think it just makes sense to be a little bit more conservative and to not take and when it you know as it pertains to financing, not take the extra risks of getting a floating rate deal or buying something that doesn't cash flow. You know, I think it's just a good time to stick to the fundamentals and keep buying, but do it when the fundamentals work. And if the
Mhm.
fundamentals don't work, you know, you just wait till they do. Like
Yeah.
I think you have to have that sort of you know, resilience and persistence and determination to find the right deals because they're out there. I mean, I
Mhm.
see them, um, but you need to work extra hard to find them these days.
Yeah, awesome. Okay, so we're about to split out into breakout rooms. So give me a second here. Derek, thank you so much for taking this time and coming on and sharing this with us. What?
My
Oh
pleasure,
wait,
guys.
last question actually. What's the
Yeah.
word on the Arbor in the Arbor Street or the Wall Street of when are we gonna see the interest rates come back down? What's the word on the street?
Well, you know, the market is predicting that there's going to be rate cuts by the end of the year.
Uh-huh.
Um, I don't know. I don't know about that. I hope. And then there are different rates, right? You know, there can be the prime rate, there can be the benchmark rate, and then there are treasuries. The treasuries, the treasuries are a better view of what's going to happen over the long term. So if you look at the 10-year treasury at 3.5%, they're telling you in 10 years that's about where rates should be. If you look at the 1 year, it's more like 4%, you know, or 4.25. So they're sort of telling you rates are going to be a little higher for the next year than they're going to be. So I think that rather than you know following the what the Fed's doing, if you watch the treasuries, you'll get a good feel for it. But Wall Street is predicting the money is on the Fed cutting rates by the end of the year. That's where
Yeah,
the money is.
we trust all
Not
those
my money.
guys. We trust all those guys. All right,
My
so
money is in the I don't know camp. I'm going to just make sound financial decisions today, so it doesn't matter what they do. You know?
that's a good point. All right, so Jennifer's got her hand up. So Jennifer, last question, last thought, and then look, we're gonna break out into we're gonna split you guys up into 5, 6 people per room, and just kind of share with each other what you guys learned and get to know each other because these networking this is an opportunity to meet somebody. Like if you've already been here for an hour and change, so meet somebody And who knows? It could be a deal. This could be $1 million meeting right now. So I know as soon as I say these things, the number just starts dropping. People are like, oh, I don't want to meet new people right now. I just want to get information and bounce. But meeting people is probably just as valuable as what Derek is sharing right now, because your network is your net worth. All right. So go ahead, Jennifer.
I
Take
just
us
wanted
out.
to I just wanted to piggyback off of what Derek mentioned. Of course, if you can find a deal that underwrites well and cash flows in any market, that's, and that's when it makes sense. Absolutely go for it. Best to err on the side of being a little bit conservative always, because we never know what's going to happen. But secondly, I wanted to say I was at the Connect LA conference just a couple of weeks ago, and a number of industry leaders were there, like super prominent people. And the general rule of thumb was that we might be seeing rates come down in the next 6 to 9 months. And then because people are emotional creatures, it might take an additional 6 months for people to start taking action and then, buying properties again. So not to say properties aren't being bought now by the more sophisticated folks who are comfortable, but that's that.
Awesome. Thank you. Thank you for your
Mhm.
share, and thank you for your contribution here tonight.
Of course.
I look forward to chatting and getting to know you better.
Yeah. I was introduced to this group by Joyce Johnson, so I just want to give her a shout out, and
Oh,
I appreciate
Joyce.
you for hosting. Yeah.
Cool. Awesome. I will reach out to you. I will find you and we'll set up a time to chat. Okay.
Let's do it.
Awesome. Next week we're gonna have Derek. Thank you again, brother. Thank you for
Thanks,
being here.
guys.
Appreciate you. Next
Anytime.
week we're
Have a
gonna
good night,
have
guys.
we're take it easy. We're gonna have Miranda. Miranda's she's amazing. She's gonna come and talk about, sound financial investment strategies, and how she looks at, how each of us individually should be investing our money, saving it, all the different things. She has like a formula that kind of tells you how much you should be investing and all that stuff. So she's going to be here. She's a really amazing person, and we'll talk about some of that stuff. And also, the truth of life insurance, whole life insurance, universal insurance, like that's going to be also discussed on that call. So, just another great speaker that's going to be joining us next Monday. Okay, so we're gonna break out. Nick, if you can send people, and we'll just do one breakout room unless everybody wants to do more. We'll do one breakout room, share with each other where you're from, what you're doing, what you're up to, what you learned today, and get to know each other and make sure everybody gets a chance to talk. So whoever is the controller, right? You guys know who you are. Just go in there and kind of get a stopwatch going and give everybody like 2 minutes or so. All right. Well, there goes half the people when we're about to break out. So go ahead, Nick.
There